Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Capstone Holding Corp, and let's just say some of their numbers are as solid as a house built of cards. This video will look at Capstone's latest financial checkup, a quarterly report that gives us a peek into how they're doing. We'll see where they're making money, where they're losing it, and what risks they're facing. It's like being a doctor, but instead of patients, we're diagnosing companies. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, where you can discuss this and more with other investors. First off, this is a Form 10Q, which is a report companies file with the Securities and Exchange Commission, or SEC, every 3 months. It gives investors an update on their business and finances. This report covers a period up to March 31, 2025. Capstone Holding Corp, the company behind all this paperwork, uses the ticker symbol CAPS. Their common stock is traded on the Nasdaq Stock Market LLC. This filing outlines the financial status, including the balance sheets, income statements, and cash flow statements. It also discusses what the company's management thinks about their performance and what could affect them in the future. Let's get into those all-important numbers, and we will begin with the assets. Accounts receivable, which is the money owed to Capstone, increased to $4.5 million compared to $220 million at the end of last year. This isn't necessarily bad, but it means that more of their revenue is tied up in unpaid bills. Inventories, which are goods ready to be sold, are at $9.8 million, about the same as the end of last year. Looking at cash, the company went from almost nothing at the end of last year to $1.7 million. That's a huge jump. Property and equipment are slightly down at $1.5 million, so they didn't buy much in the way of long-term stuff like buildings or equipment. Goodwill, which is the value of a company's brand and reputation, remains high at $23.3 million. They also have a deferred tax asset of $7.2 million. This is like a tax credit they can use in the future. Now onto liabilities, or what the company owes. Accounts payable increased to $4.4 million. Their line of credit, which is like a credit card for businesses, increased to $7.7 million from $6.3 million at the end of last year. Looking at the long-term debt, it is at $7.5 million. Common stock is listed at around $3,000. That's due to the low per share value and the high number of shares that have been issued. Additional paid-in capital, which is money investors paid above the face value of the stock, increased significantly to $25.5 million. The accumulated deficit, or total losses, over the company's life is around $198 million. Let's switch over to the income statement. Net sales were down $799 million versus $94 billion for the same period last year. That's about a 16% decrease. Cost of goods sold also decreased in line with the sales decrease. Gross profit was down $1.3 million compared to $1.7 million. Selling, general and administrative expenses increased to $228 million. This tells us they couldn't adjust their operations to the decline in sales. The loss from operations doubled from $717,000 to $1.4 million. That's never a good sign. Interest expenses are $300,000. The net loss came in at $1.7 million, which is worse than last year. The net loss to the common stockholders is around $2.4 million. Here's a key detail. The weighted average number of common shares increased a lot, from about 157,000 to over 5 million. That means existing shareholders now own a much smaller piece of the pie. Let's move on to the cash flow statement. The net loss again is $7 million. Depreciation, amortization, which are non-cash expenses, were pretty stable at $106,000. Accounts receivable and other assets used $2 million in cash. Accounts payable and accrued liabilities provided $1.5 million in cash. The net cash used by operating activities was $2.3 million. There were no cash flows used in investing activities. They borrowed about $1.5 million from their line of credit. They paid $910,000 in debt. They received $109,000 from deferred IPO costs. They brought in about $3.3 million from issuing stocks. Net cash provided by financing activities overall was $4 million. Their cash position at the end of the period was $1.7 million. Interest paid was around $300,000. Now, let's zoom out and get a better understanding of what Capstone actually does. Capstone Holding Corp is a holding company, and its main asset is Total Stone LLC. Back in 2020, Capstone took control of Stone, which is a company that sells masonry stone products in the Midwest and Northeast United States. They operate under the names Instone and Northeast Masonry Distributors. In March of 2025, Capstone completed a public offering selling shares. The shares were sold at $4 a share and brought in $3.3 million after subtracting the costs. Stone entered into an agreement to govern how it operates and its relationship with its members. Stone's interests were exchanged for 3.8 million shares of common stock. This was allocated to the previous members. Special preferred membership interests were exchanged for about $1 million in loans plus interest. Capstone also increased the amount of shares it can issue. The company has to make estimates and assumptions when they do their financial statements. This is normal. They also have to estimate the amount of money they won't collect from their customers. They base this on past experience, economic conditions, and other factors. End of March, their allowance for doubtful accounts was about $104,000. Their inventories are valued at the lower of cost or market value. As of March, they had about $104,000 in prepaid inventory. They depreciate their property and equipment over a period of 3 to 40 years. Goodwill is not amortized but is tested for impairment annually. Long-lived assets are reviewed for impairment whenever events occur that indicate that the carrying amount may not be recoverable. Sales are recognized when the product is shipped. Basic earnings per share is computed by dividing the net income by the number of shares outstanding. Calculations of basic and diluted loss per share are the same because potential dilutive securities would have had an antidilutive effect. The company is reviewing new accounting rules. The company talks about having working capital to operate for at least 1 year. The company relies on cash from operations and capacity under our ABL facility, which is a type of credit. They also mention that they have the right, but not the obligation, to sell up to $20 million in common stock to an equity line investor. Stone has an agreement with Brookstone Partners, one of the company's shareholders. Brookstone provides consulting services. Stream Finance LLC, which serves as a creditor on Stone's mezzanine term loan, is managed by Brookstone, paid Brookstone. $200,000 for financial advisory services. Stone has a revolving credit note available. The balance outstanding was $7 million. As of March, the company had $8.8 million in long-term debt. Here are the details. S-note payable to BP Peptides LLC with a 6% interest rate totaling around $827,000. Mezzanine term loan to Steam Finance LLC with a 14% interest rate totaling $2.8 million. Sells note with Avalina Masonry LLC in default and accruing interest. In December 2022, Stone sold its facility in Navarre, Ohio, and concurrently entered into a leaseback transaction. Unsecured promissory note with Brookstone plus accrued interest. Here are the scheduled debt maturities. EPS around $1 million due this year. IL $4.7 million due next year. Right of use assets were $3.4 million and lease liabilities were $3.5 million. Total lease expense for the quarter was $232,000. Capstone has no outstanding shares of preferred stock. The company designated 2 million shares of the company's authorized preferred stock as Series B. Preferred stock have the right to vote. Series B's preferred stock is convertible into common stock at the holder's option if the common stock reaches $40 per share. The company operates in one segment consisting of Stone LLC. Here's a breakdown of Stone's financials. ISL's $7.9 million from operations, $1.1 million from operations, $1.1 million. In May 2025, the company entered into a common stock purchase agreement and a registration rights agreement with an accredited investor. Under the terms and conditions, they have the right to sell the investor the company stock. Those are the exhibits. So what does all this mean? Capstone is trying to grow through acquisitions and by expanding its product lines. They are running into an issue with their profitability. The accounts receivable have increased, so they are waiting for more payment. They had a big increase in their cash due to outside financing. They're giving away more of their stock. Net sales are going down. Their loss from operations more than doubled and so all in all, the company is not in great shape. Their sales are down and they have to borrow a lot of money to stay afloat. It is worth keeping an eye on them. Alright, that's our breakdown of Capstone's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.